Have you ever bought a stock just because it looked cheap, only to realize later that it was cheap for a reason? Maybe the price was low, but the business was hollow. Maybe the valuation looked attractive, but the future was quietly fading. That moment, when the illusion breaks, is the moment many investors finally understand Charlie Munger's upgrade to value investing. He didn't just teach us how to pick stocks. He taught us how to choose the companies worthy of holding for a lifetime. And today, we're going to explore exactly that. How Munger took Graham's original framework, the world of bargain hunting, discounts, and scraps, and turned it into something more elegant, more durable, and far more powerful for long-term compounding. Welcome to Invest in Wisdom, a channel where we learn from great minds, study great companies, and grow our money and our thinking step by step. If you find value in these calm, structured explorations, feel free to subscribe. It helps the channel grow and keeps you connected to weekly insights. Now let's begin with Chapter 1, the shift from buying cheap to buying great. Ben Graham, the father of value investing, built his philosophy in a world filled with inefficiencies. Back then, information traveled slowly. Financial statements were harder to access, and mispriced companies, true bargains, were everywhere for those willing to look. He taught investors to search for the undervalued, the overlooked, the little cigarette butts with one last puff of value left. For decades, this approach worked beautifully. But the world changed. Technology accelerated. Competition intensified. And the spread between an average company and a truly great company became larger than ever before. In this new landscape, cheap stocks were no longer enough. Some stayed cheap forever. Some were dying businesses wearing the mask of value, and some offered low price but also low potential. That's when Munger stepped forward with a new dimension of wisdom. He said something simple, almost gentle, but utterly transformative. A great business at a fair price beats a fair business at a great price every time. Because price reflects a moment, but quality reflects a decade. And only quality can carry your capital through storms, cycles, and uncertainty. Value Investing 2.0 begins here, with the understanding that the real treasure is not in the discount, but in the business itself. If Chapter 1 taught us what to look for, great companies instead of cheap ones, then Chapter 2 teaches us how to recognize greatness. Charlie Munger believed that a truly exceptional business reveals itself through 3 filters, not 1, not 2, but 3 layers of clarity that help us separate the extraordinary from the merely acceptable. The first filter, the moat. A moat is the company's shield, its quiet defender, its ability to remain strong even when competitors surround it on all sides. A moat might come from a cost advantage that rivals simply cannot match, or a brand that shapes emotions long before it shapes revenue. Sometimes it comes from network effects, where every new user strengthens the entire ecosystem. And sometimes It's the simple reality that switching away would be painful, inconvenient, or irrational. A company without a moat must compete every day. A company with a moat can grow every day. The second filter, management. Munger admired leaders who were not only intelligent, but also deeply rational. Leaders who allocate capital like it's sacred, who avoid unnecessary risks, who protect shareholders instead of diluting them, who communicate honestly without hiding behind buzzwords or excuses. Many companies rise because of products, but the ones that endure, they rise because of people. People who make wise decisions again and again, across decades, across cycles. Good management can save a mediocre business. Bad management can destroy a great one. The third filter, culture. Culture is the invisible architecture of a company. You can't touch it, but you can feel it in the way employees speak, in the speed of decisions, in how customers are treated when no one is watching. A strong culture attracts talent, keeps turnover low, and creates an energy that compounds. It allows a company to innovate without chaos, expand without losing its identity, and face setbacks without collapsing. Culture is the heartbeat. When it's steady, the whole company moves with confidence. When all three align, when moat, management, and culture all point in the same direction, you no longer have a typical stock. You have a long-term companion, a business that treats your capital with respect, that grows from within, and that can survive storms simply because its foundations are deeper than the storms themselves. These filters were Munger's compass, and if we learn to use them patiently and repeatedly, they will guide us toward companies that do not merely survive the future, but shape it. If Munger's first revelation was that greatness matters, and his second was how to identify it, then Chapter 3 delivers the final shift in mindset. Cheap is optional. Quality is essential. For decades, investors believed price was everything. Low PE, low book value, low expectations. The cheaper, the better. But Munger quietly shattered this idea. He showed us that a company's true value comes from its ability to compound, not from the discount tag attached to it. A cheap company without growth is like a car with no engine. The price might be attractive, but it's not going anywhere. A great company with real earning power, strong returns on capital, and durable competitive advantages doesn't need to be cheap to create wealth. It just needs time. That's why Munger often said the goal is not to buy the lowest price. It's to buy the highest quality at a reasonable price. A reasonable price gives you safety, but quality gives you the future. Think of it this way. Price is a snapshot. Quality is a movie. A cheap snapshot can fool you. A great movie rarely does. Munger also warned investors about falling into the classic value trap. the companies that look cheap because their future is shrinking. They trade at low valuations not because they're mispriced, but because they are fading. They have high debt, declining earnings, or shrinking industries. And even if you buy them cheaply, they repay you with years of stagnation. Cheap is only an advantage when the business beneath it is alive, healthy, and capable of long-term growth. But when the business is rotting, cheap becomes a trap, not an opportunity. Munger preferred companies with consistent earnings, rising free cash flow, and a culture of innovation, even if they were priced at a premium. Why? Because great companies create value internally. Every product improves. Every process becomes more efficient. Every year, the brand grows stronger. They compound from within. And compounding from within is the strongest wealth engine an investor can ever partner with. So, when you evaluate your next investment, ask yourself not, is it cheap, but is it great? And is the price reasonable? Cheap is a bonus. Quality is the core. And over the long run, quality always wins. To truly understand Munger's philosophy, we must look at the companies he chose not just to buy, but to own. His investments were never random. Each one reflected a principle, a way of thinking, a quiet discipline that guided him for decades. In this chapter, we walk through 3 of his signature cases: Costco, BYD, and See's Candies. 3 very different businesses, yet all united by the same DNA. Moat, management, and culture working together in harmony. Costco, culture as a competitive weapon. When Munger spoke about Costco, his voice carried a kind of admiration you rarely hear. To him, Costco wasn't just a retailer. It was a philosophy of service, a company that built trust so deeply that customers returned not because of marketing, but because of belief. Costco's moat didn't come from fancy technology. It came from discipline, from razor-thin margins, from treating customers honestly, from treating employees fairly, and from a culture that said, "We will give people more value than they expect." Most companies try to raise margins. Costco tries to lower them. And that paradox became its competitive superpower. Customers trust Costco, employees stay for decades, and the company grows through loyalty, not hype. This is the kind of business Munger loved, a company where culture isn't decoration but strategy. BYD, betting on people, not just numbers. Munger's investment in BYD is perhaps the clearest expression of his belief that numbers matter, but people matter more. He didn't fall in love with BYD because of valuation. He fell in love because of Wang Chuanfu, the founder who could build a company from nothing with sheer intelligence and discipline. Munger once said that Wang is the combination of Edison and Ford, a creator and a builder in one. BYD had the engineering talent, the manufacturing efficiency, and the visionary leadership to transform multiple industries at once. Batteries, electronics, automobiles. This was not a bet on a spreadsheet. It was a bet on a mind, on a leader with the rare ability to push a company through multiple S-curves of growth. To Munger, BYD showed that greatness is not an accident. It is the result of relentless intelligence and moral discipline at the top. See's Candies, the economics of a lovely business. See's Candies is the gentle, elegant example Munger referenced again and again. Why? Because See's is the perfect model of what a wonderful business looks like. Strong brand, beloved product, pricing power, high returns on capital, low need for reinvestment. See's doesn't compete on price, it competes on affection. People don't buy See's because it's cheap. They buy it because it's See's. The company takes $1 of capital and turns it into many more dollars of profit year after year, with almost no drama. The beauty of See's is that it compounds quietly. No fireworks, just steady, elegant economics that continue for decades. The pattern behind the stories. Costco shows the power of culture. BYD shows the power of leadership. See's shows the power of brand and economics. Different on the surface, yet spiritually identical. Each company embodies the three filters: Moat, management, culture, executed with excellence. And that's why Munger loved them. Not because they were the cheapest, but because they were the most durable. To invest the Munger way is to choose companies that respect your capital, respect their customers, and respect themselves. That is the essence of value investing 2.0. After understanding Munger's philosophy, the next step is to bring it down from the clouds and let it walk beside you in every investment decision you make. Value investing 2.0 is not an abstract idea. It is a way of living with your money, calmly, wisely, with a sense of direction instead of noise. The first step is simply choosing a handful of companies you truly understand. Not 50, not 100, just a small circle you can describe clearly, a group of businesses whose products you've used, whose leadership you've observed, whose long-term story you can actually see. When the world becomes chaotic, this little circle becomes your anchor. Once you know which companies belong in your world, you begin seeing them through Munger's lens. You watch their moat, not by reading fancy reports, but by observing whether competitors can really threaten them. You watch the management, not by chasing quotes, but by noticing how rationally they allocate capital and how honestly they treat shareholders. And you watch the culture, the silent heartbeat that shapes everything. A healthy culture keeps a company moving forward even when the economy slows down. When these elements stay strong, the company becomes more than a stock. It becomes a long-term partner, a place where your money can rest and grow without being shaken by every headline. Then comes the question every investor fears: when should I buy? Munger's answer is wonderfully simple. You don't need the cheapest price. You need a reasonable one. A price that makes sense when compared with the company's quality, its competitive strength, and its ability to grow for many years ahead. Reasonableness gives you comfort. Greatness gives you compounding. And when the two meet, you don't need perfection. The hardest part, however, is not buying. It is holding. It is resisting the temptation to react to every dip, rumor, and wave of emotion in the market. Munger held great companies for decades because he knew the real magic was happening inside the business, quietly, invisibly, in the form of brand growth, process improvements, and rising cash flow. Your job is not to predict the market. Your job is to watch the company. If the moat is intact, if the leaders remain rational and honest, if the culture is still alive and strong, then time becomes your ally. The snowball rolls on its own. Value investing 2.0 is not about searching for shortcuts. It is about choosing clarity over confusion, quality over noise, and patience over panic. Invest in a few great companies at fair prices, give them years instead of weeks, and let the quiet power of compounding do what it has always done: turn small decisions into extraordinary results. If there is one lesson Munger hoped every investor would carry, not just in the mind but deep within the heart, it is the quiet, transformative power of compounding. Compounding is not a technique. It is not a clever strategy. It is a relationship between time, discipline, and the quality of the companies you choose to partner with. Munger understood something most people overlook. Your portfolio grows when you stop interfering with it. Great businesses know how to improve themselves. They refine their products, strengthen their culture, earn deeper trust from their customers, and make wiser decisions year after year. When you give such businesses enough time, they do far more than grow. They evolve. They shift from being investments into long-term companions that quietly reshape your financial future. But compounding reveals its magic only to those patient enough not to interrupt it. Munger often said that in a lifetime, you may only find a handful of truly great companies. And when you find them, your responsibility is beautifully simple. Don't let go too early. Not because the market shouts, not because headlines panic, not because noise demands action, but because the company itself continues doing the quiet, disciplined work that will make the next decade better than the last. The real enemy of compounding isn't volatility, it's restlessness. It's the human urge to react before thinking, to copy others, to fear temporary declines that mean nothing over a 10 or 20-year horizon. Munger reminds us that enduring wealth belongs to those who remain calm in a world addicted to noise. A great company, held with patience, becomes more than a number. It becomes a story you grow with, a partner that rewards your discipline with possibilities you never imagined. So, as we close this journey through Value Investing 2.0, let the final message stay with you. Choose quality. Buy at fair prices. Give time the freedom to work. And trust that quiet wisdom often builds the strongest future. And if these ideas brought you clarity, if they helped you think a little deeper and invest a little wiser, I invite you to stay on this path with us. Feel free to subscribe, leave a like, and join our community of thoughtful, patient investors. Let's continue learning from great minds. Let's keep building long-term wealth, one calm insight at a time.